Since the start of hostilities in Ukraine, the sharp correction in the bond market and the tightening of monetary policies to curb inflation, real estate has suffered a real setback. The investment market in Europe has declined by nearly 2/3 in volume. So after 3 years of turbulence, what is the market situation and what are its prospects? Firstly, investors have made a profound change in their real estate allocation by altering the nature of the risks they are willing to take. Today, they're focusing on operational assets, hotels, managed residential, or the acquisition of operational platforms on traditional asset classes such as logistics and offices. They believe that future value creation will come more from the business attached to the assets than from the capital appreciation of properties. These operational risks are replacing the traditional 3Ds: decay, default, and drift. Decay. Without regular maintenance, the building falls into disrepair and is no longer desirable for tenants. Default. The tenant may default or leave the building, resulting in an immediate loss of rent. And drift. Cap rates rise, which dents the value of the building when it is unsold. In reality, it's as if property investor realizing that owning a building is not simply a financial investment, but rather a physical asset that must be maintained and marketed regularly. Secondly, investors are looking to diversify their rental income. They are therefore interested in managed residential properties with multiple individual tenants, student accommodation, serviced apartments, co-living, senior accommodation. They're also interested in hotels with a revenue mix between business and leisure customers, as well as domestic and international demand. Finally, they're also interested in mixed-use properties, particularly those office buildings that offer facilities open to the public, whether leisure or restaurants, as well as convenience stores. And finally, as to debt financing, after a period of tightening credit policies, lenders have entered a more aggressive cycle. This relative easing is partly due to the scarcity of core real estate transactions and partly to pressure from a handful of alternative lenders that have raised significant amounts. A classic supply and demand dynamic. So how might the market evolve in the medium term? Today, the yield curve has stabilized and normalized. That should be a strong buy signal for the recovery of investment volumes. However, risk-free rates stabilize at a high level and they vary greatly between Eurozone countries. In France, the 10-year OAT hovers around 3.5%, and many investors remain deterred from selling at current prices. So it is hard to predict whether the conjunction of these two factors will lead to a thaw. However, market participants have accumulated a lot of liquidity, and that should translate into a quick-paced recovery if and when it does occur.